So far, do you need system? You need like extra, just to trim whatever you don't understand and clarify.
So far, no.
If there's no choice, then we have to like make extra classes for cyber because next week will be the last week, huh?
Oh, okay.
Yeah, and then we have a test on Friday, huh? 7:30. Okay, so let's cover what we have. Okay, what we have covered last week. We covered the bank reconciliation, isn't it? Okay, the bank reconciliation and what was it? Uh, Inventory. Okay, so bank reconciliation. What you do? Okay, because we have two record. One is cash book that is in the sole proprietor, and then the other one is the bank statement from the bank. Okay, so we have to do, and the business, okay, need to do bank reconciliation statement every month. Okay, because even though they are two same recording the same transaction, but we have the timing difference. Yeah, timing difference. So therefore, they are always different. So we have to identify what causes the difference and rectify. Yeah, okay, and show it in the bank reconciliation statement. So the step is we do the ticking. Okay, that is one of the method, one of the question. Do the ticking by comparing. So those untick in the bank statement, you update into revised cash book. Those untick in the bank statement, sorry, those untick in the cash book will appear in the bank reconciliation statement. Okay, so that is what we what we call it, the process. Now, can you hear me properly, or is it? I mean,
Ah,
Clear.
yes, can.
can I? Okay. And if we make an error, yeah, in the cash book, so it has to be corrected in the revised cash book. So you have to look at the nature of the error. If it's overstated on the payment side, so we have to make the entry on the credit side. If understated on the debit side, the deposit, then we have to do debit entry. If the mistake done by the bank, error made by the bank, then we have to show it in the bank reconciliation statement. So same thing. We have to look at the nature of the error. Okay, so that is bank reconciliation. So today we're gonna learn preparation of financial statement and closing entry. Okay, is it big enough? Is it okay?
Yeah.
All right. So look at the objective. We need to do closing of general ledger account to the statement of profit or loss. So meaning closing off is only for revenue and expenses. So revenue is a credit item, isn't it? So when you close off, you have to make a debit, the opposite entry, debit entry. We debit the revenue and we credit to SPL. But credit in SPL is add because we are preparing the statement form. And for expenses is a debit item. So to do the closing, we have to make opposite entry by crediting. Okay, we credit the expenses, we debit the statement profit or loss. But again, because we are preparing the statement form, so that will be represented as less. Okay, and then what about the other three category, asset, equity, liability? So we balance off. Yeah. balancing of general ledger account to be carried down to the next accounting period. So only asset, equity, liability you carry forward from one year to another year. So that's why we have debit balance for asset, credit balance for equity and liability. Now, how to deal with drawings account and the net profit figure calculated in the statement profit or loss. So drawing a net profit, we have to put or we have to show it in the equity side. So drawing reduce equity, net profit increases. So if it increases, we plus. If it's decreasing, reducing, then you have to minus. Yeah. And then prepare to finalize statement of sole trader. So this is a must. This is one of the question. Okay. So closing entry. After all the necessary year-end adjustment. So the year-end adjustment, we are referring with uh, what we have learned. Okay, we have learned providing, writing off the bad debts, providing allowance for doubtful debts, either increases or decreases. If it increases, it will be expenses. Decreases, it will be a revenue. All right. And then we have depreciation, okay, and we have prepayment, we have accrual. Prepayment, remember, if it's expenses, so we have to minus, we have to reduce the expenses. Same goes with revenue, we have to reduce. Okay, but then the expenses become, the prepayment and prepaid expenses become an asset. But prepaid revenue is the opposite, become a liability. Okay, so those you need to remember. So what is the reason being doing this year-end adjustment? Why we have to learn this? Because the business need to do all this adjustment as to observe. Okay, the accounting concept, the financial statement should be presented with fair view of the true and fair view in the financial statement on performance and financial position. Okay, and the final step is to close the general ledger. So general ledger, we're talking about the revenue and expenses. So this is the first process. Closing the general ledger involve, we call it, in general, we call it closing. But one is closing off and one is to balance off. Okay, so look at this, balancing off. So closing off general ledger, all that we are referring with income and expenses account in the general ledger. We close off. Okay, by close off meaning we don't carry forward that balance. We close that account. So that is the expenses for the year. No more will be bring forward to the next following year. So that is the meaning close off by transferring the total balance to the statement profit or loss at the end of the accounting period in order to calculate the profit or loss for the period. So we want to measure the performance of the business. So nothing is brought down to the start of the next accounting period, meaning we don't treat like the asset we bring forward to the next following period. Okay, so the only figure between the difference between revenue and expenses, we only have one figure. So that is known as profit. This is what we carry forward or we record into the equity. That's all. Okay. So income and expenses only. Remember that revenue and expenses. Income and revenue is the same. Okay. It will be charged to SPL, statement, profit or loss. So like what we have here, this is representing revenue account. So we take the example, sales account. So any revenue account, you have to do this process. Any expenses account, we have to do like what we do the carriage inward account. Okay, so sales account. Remember, this is revenue, so a credit item. So increase, okay, increase of a debit item Okay, we do credit entry. Okay, this is credit sales. And then this is cash sales. So increase, isn't it? So we do credit entry. And then carriage inward is a debit item. Increase of carriage inward, okay, paid by cash 500, paid by check 2000. So we debit. At the end of the year, then we do closing. Okay, this is what we call closing off, end of the year. So how do we close? So we have this total line, single line on the top, double line underneath. So it must be in the same row. So 65,000, we select this amount because this is the highest total on the credit side, credit item, isn't it? Only increase. So 65,000, and then we transfer that 65,000 into SPL. So like what I've said just now, a credit item, we have to make opposite entry, that is debit, to close it off and send it to SPL, post it to SPL. So same goes with debit item, carriage inward. We close off, okay, put this value 2005, and then we make opposite entry by crediting debit item, and then close it off by posting to SPL. So when we do the posting, okay, what happened? It will goes to statement profit or loss. Look at this extract for the year ended 31st of December. Okay, sales, this is debit, isn't it? So we credit in SPL, but then we don't see credit, but this is actually add is representing credit, less representing debit. Okay, so we put 65,000 on the last column. Okay, because sales is always on the top. And then carriage inward is one of the cost of goods sold. So you look at this. This is less. Less is debit. Okay. So we already posted. So we charge revenue and expenses into statement profit or loss. So in the end, we only have profit to represent the revenue and expenses. Okay, that is the first process. Now, the second process is balancing off general ledger account. Now, balancing off, when we talk about balancing off, we must have balance CD, balance BD. Okay, if you have a T account, so on the top, this is your total column, total amount. So if it's debit balance, so CD above the total on the credit side. BD below the total on the debit side. So this is what we call debit balance. Okay, this is only for asset, liability, and equity. So now you should know asset is debit, liability and equity is credit. Account in a general ledger carried down at the end of accounting period. Okay, we have balance CD. Capital account must transfer from drawing account and net profit from statement profit or loss before being closed. Okay, so drawing and net profit will be shown in the capital account. So there are three: capital account, drawing, and net profit. We show it in the equity side. Okay, so this is what happened. So how we balance off. So office equipment is an asset, a debit item. So we will have CD above the total, BD below the total on the debit side. BD is on the debit side, so 150,000. Accumulated depreciation using liability concept is a credit item, isn't it? Okay, so 30,000 here. So we close CD and BD. BD is on the credit side. Any problems so far? Can you follow, Aaron?
Yes.
Okay. And then trade receivable control account is an asset. So we have a debit balance, CD above the total and BD below the total on the debit side. Okay. And then drawing account. So we have to close this account and then transfer it to capital account. So drawing, remember, is reducing equity. So it will be recorded on the debit side. So any increase of drawing will be debited, like what we have here. The sole proprietor took out money from the bank, 3,000 for his personal use. So we debit drawing and credit bank. And then taken the trading item for personal use. So we debit drawing, we credit purchases. So this is the heading of account that is being credited. Then we transfer this account to capital. Okay, put the total value first, 8,000, 8,000, and then this 8,000 will be posted to capital. We credit drawing, we debit capital. Okay, 8,000. And we have a profit, isn't it? So remember, capital account is equity concept, credit item. So any increase of capital will be on the credit side. So opening balance will be on the credit balance brought down, and then net profit increases the equity, the capital account, so we credit, and then drawing decreases, so it's debit. So we have closing balance. Okay, first of all, put the value. Okay, the value is credit total 522. Use that value as a total for debit side as well. And then 522 minus 8,000. So this is your credit closing balance of your capital account. And you have to show this in your statement of financial position. Okay, so this is the extract. So your non-current asset, show the office equipment less with accumulated depreciation. So this is the net book value, 120,000. Put in the second column. And then current asset, we have trade receivable. Then this one should be a total asset. And then equity, because this is only extract. They don't show you the total because we don't have full version of the statement of financial position here. This is only showing where should we put the the item. Okay, the office equipment with accumulated depreciation will be under non-current asset. Trade receivable will be under current asset. And then for equity, how do we present the equity? So we have to break it down according to what we prepared in the ledger just now, in the ledger account. That is the opening capital, 500,000, add with the net profit, okay, and then less with the drawing. So this is your closing balance for your capital. So you have to break it down. So because all of these are marks, so you can't just put the final figure 514,000. So you break it down, show it itemized. Yeah, all these are marked. So this mark will be given, okay, and then this. And the last one, the closing. Okay. Now, preparation of financial statement of sole proprietor. Now, once the general ledger account have been closed off and balanced off, a trial balance will be prepared, followed by necessary adjustment. So trial balance, we have to prepare listing down all the debit item and credit item accordingly, just to check the arithmetic accuracy. Thereafter, the financial statement of sole proprietor will be prepared. So trial balance will be provided, but the students are required to make the adjustment as per the additional information given. So meaning we in the question there will be an additional information which not been recorded, the double entry. So we have to do the double entry, but then we don't see debit and credit, but we only see plus and minus on it. We see plus and less. So if it's debit item plus meaning it's debit. If it's less, this is credit. So we only see this. If it's a credit item, okay, plus means credit, increasing, isn't it? And then minus means debit. So we don't see this debit and credit exactly, but that is the understanding because everything is prepared in the statement form. Okay, so plus is actually increase. Yeah, minus decreases. So we still observing the double entry, but you don't see it in the when we prepared with adjustment. Okay, look at this illustration. Mr. Brian, a boutique retailer, provided the following balances that were extracted from his business ledger as at 30th of June 2017. So the accounting year end is very important. So if this is ending 30th of June, so beginning, what is the date after June? That is 1st of July. And then the year you move backward, 16. So meaning this is the duration, 1 year. Okay, so this is the accounting period duration. So why this is important? Because we want to see whether those expenses, those revenue, okay, falls within this period gap. Yeah. Okay. So that's what the most important thing. That is why you see inventory 1st of July 2016 is indicating opening inventory. Okay, is an asset, yeah, but then it is part of the cost of sales also. So we have, okay, so remember debit only asset and expenses. Debit item, isn't it? Credit, revenue, yeah, revenue, equity, and liability. Okay, so very easy. Like sales, of course, this is revenue, isn't it? And then return outward. Okay, this one is reducing the inventory. So this is purchases return. Okay, purchases return. Return outward. Okay, so you have to minus. Commission received, revenue, other revenue. Interest received, other revenue. Allowance for doubtful debts, this is using liability concept. So you have to minus with trade receivable. And then 11,000 trade payable, so liability, current liability. Bank overdraft, current liability. Capital, under equity. Okay, so you need to be able to identify. So like purchases, of course, this is cost of sales. Yeah, and then return inward, cost of sales. So this one also cost of cost of sales. This one is sales return. So you need to minus with the sales. Sales return. And then wages, cost of sales. Salary, cost of sales. Sorry, salary not. Yeah, this is other expenses. Okay, carriage inward, cost of sales. Carriage outward, expenses. Import duty, cost of sales. So you have to use your judgment. Some of the expenses that you feel this is related with to make the purchases, then you put under cost of sales. Like insurance for purchases, this is cost of sales because of this word purchases. Office insurance, So other expenses, rent expenses, utility expenses, commission received revenue, interest received revenue. So this one liability, fixed deposit asset, okay, motor vehicle asset, furniture asset, office equipment asset, trade receivable asset, trade payable liability, cash asset, bank overdraft liability. Okay, and then capital equity, growing equity. So by identifying all this, so all the item in the trial balance has to go to any of the financial statement. So remember, SPL only revenue and expenses. SOFP asset, equity, liability. Okay, so under equity we have profit and we have drawings. Okay, so this is the guidance. Now, whatever that is in the trial balance, the double entry already completed. We don't have to do anything anymore, except the additional information. So like the first one, salary. Okay. But before that, number one, closing inventory are value at cost 6,500, but the market value is 7,900. Okay, closing inventory, remember it is not included in the trial balance because it is stated in the notes, isn't it? Where the closing inventory, we can only get the figure after we do the stock taking. Okay, so therefore, it is not included in the trial balance. So this is an asset. So the first thing, when we have this closing inventory, how do we do the recording? So we have debit entry, we have credit entry also. That is, we debit closing inventory, okay, which you see, closing inventory, when we do closing inventory, let's say this is inventory. So how do we record? And then we have ledger account also. Okay, so SPL, remember? Inventory 6,500 is an asset, isn't it? So any increase, so meaning these are the remaining good. So increase of inventory, isn't it? Because of this figure, we have an increase of inventory. So we debit inventory, and this is debit. And what is the heading of account that is being credited? We credit SPL. So in SPL, it should be on the credit side, correct? So inventory. But we are preparing SPL in a statement form. And since inventory is related, okay, related with cost of sales, so that is why it is presented together with cost of sales, where opening inventory plus purchases. Now, okay, remember this cost of sales is on the debit side of SPL, isn't it? Inventory is on the opposite side. So we have to change the symbol, become minus closing inventory. So that explains why we have this formula in statement profit or loss, that is cost of sales, open inventory plus purchases less closing inventory. Okay. Now, then this you have to carry forward. Okay. So we have to balance off, balance CD, 6,500, and then balance BD on the debit side, 6,500. So that's why it appears in SOFP under current asset. Okay, can you understand? Elvin?
What appear in SOFP?
Yeah, this inventory will be in SOFP, Statement of Financial Position, under current asset. Okay, remember, as I told you just now, SOFP, Statement of Financial Position, okay, asset, equity, liability. So under asset, remember we have non-current asset and then current asset. So one of them is closing inventory. Okay.
The opening and closing inventory both in current asset or they in different
Opening
categories?
inventory, we don't record under current asset because opening inventory already become an expenses here.
Only closing inventory.
Yeah, only closing inventory.
Oh,
But you must understand what is closing inventory means. Closing inventory is the remaining item that is not being sold yet. We haven't sold to the customer, so it is inventory, meaning stock. It's still with the business, so that's why it is an asset. So we still carry forward to the next following year. So that's why it appear in the current asset. Okay. Fair? Can you get the idea?
yes.
Okay, so let me rub this off first. And the next thing is when in inventory also we have learned we have to use LCN. Remember, lower. This is lower. C cost, and then M market value. Market value, okay, same as net realizable value. Okay, so you see, look at this. This is the cost. We do a comparison, and then this is the market value. So which one is lower? Will be the amount or the value that we use as the value for the closing inventory. So since 6,500 is lower, so we use 6,500. We don't use 7,900. Okay, that is the purpose. Now salary, salary 1,005 not yet paid, and prepaid rent was 800. There are two things here, so you consider one by one. So salary, if you look at your trial balance, the salary amount is 16,500. Look at this. So meaning, what does this number 2 means? This is saying to you, this is accrual. Salary 1,005 not yet paid. We already use, okay, the business already consumed this salary, consumed the expenses, but they have not made the payment. So we have to do the recording. So we have to increase the salary, a debit item. So we plus is debit. We plus 1,500. When we plus that amount, okay, when we plus this amount, we are actually debiting already. So you need to do the crediting. Where is the credit? So the credit is, okay, when you put, oh, sorry, this is debit, isn't it? So the credit is when you put into current liability. Okay, remember, current liability, increase of current liability, it will be credit, isn't it? Liability is a credit item. So increase of liability is credit. So that's why when we provide accrued salary in the current liability, so we are actually crediting already 1,005. So complete double entry. Okay. But we don't see debit and credit here. We only use plus 1,005, and then in the current liability, you put accrued salary. So that is actually completing the double entry. So the understanding is, remember as what I've said to you, if it's plus for debit item, that is debit entry. For plus in the current liability, that is credit entry. Okay, just now I said debit item, and credit item. Okay, so when we plus, so that is actually increasing. So remember, increasing, of course, you do debit entry, isn't it? Credit entry, increasing is credit entry. But if it's minus, okay, it's reducing. So if it's debit item, so we do credit entry. And if it's credit item, we do debit entry. So that is the understanding. Can you get the idea? Okay, once again, this one, prepared rent. So rent, look at this rent. Rent is an expenses. So prepared rent was 800, meaning inside this amount, okay, we have 800 belongs to next following year. So this is debit item. When we minus, we are actually crediting, correct? So where is the debit? The debit is when we provide under current asset, prepared salary. Sorry, prepared rent. $800. So this is the debit entry. This is debit entry. This one is credit entry. Okay? Boleh. Next one. Interest. This is revenue. Interest 100 is not yet received. So interest, we are talking about commission. Sorry, interest received. This one, 300. Okay, so it's a credit item. This one, credit item. So when we plus, okay, because of this wording, 100 is not yet received. So we plus 100. So this is crediting. Increase, isn't it? We plus. So this is plus, increase. So it's a credit entry. Now, where is the debit? There must be a debit. Okay, the debit is when we provide under current asset also. Okay, interest, accrued interest received. Accrued interest received or interest receivable. 100. So this is debit. Okay, same goes with this, commission received in advance. So commission received is a credit item. In advance, meaning we have to reduce. Okay, reduce, minus left. Commission received, where is your commission received? So this one, you need to minus. Okay, we minus, look at this, in advance 150. Now when we minus, we are doing this one, debit entry. So if this is debit, where is the credit? The credit is when we provide under current liability, because current liability is a credit item. Okay, so commission received in advance, prepared, or we call it prepared commission received. Commission received, 150. So when we provide this 150 under current liability, this is crediting. So debit, credit. Okay. Any questions so far? Can you follow?
Okay.
Can, eh? Okay. Next one, number 4. A trade receivable, Mr. G, with outstanding debt of 200 is to be written off as bad debts. To be written off as bad debts. So what you have learned, okay? How to record bad debts. So if we have a ledger account, okay? Ledger account, so bad debts. and then we have trade receivable. Now, trade receivable, if you look at the trial balance brought down, you have 12,700, correct? In the question. $12,700. So this is the amount of your trade receivable. Now, because of this, Mr. G, an outstanding debt of 200 to be written off. So to be written off, meaning we have to open up a bad debts account and record, because this is an expenses, we record on the debit side 200. And this is debit, so credit will be in trade receivable. So this is the double entry. So the particular in the bad debts, so trade receivable. Particular in the trade receivable, bad debts. So this is the entry, but we don't see, and we don't need to provide this ledger account. Okay, what we do by providing bad debts. Okay, bad debts. So do we have existing bad debts? You need to look at the question in the trial balance. Do we have bad debts? So if we don't have bad debts, meaning we need to provide bad debts, okay, as one of the expenses, bad debts. So when we provide this, we are actually debiting already. Bad debts, 200. Okay, so that is debit only. How do we credit? So meaning the trade receivable, you have to show in the statement of financial position. So you minus 200. Again, this is credit entry. Okay, so this is debit item. Debit item. Okay, if we less, okay, this is credit entry. So we credit and we debit. We put bad debts. Okay, so that is why if you look at your answer, you have bad debts in the other expenses, isn't it? So look at expenditure. Do you see bad debts there? 200. Okay, look at this. So we have bad debts there. This is debiting. And when we show and the current asset, we minus, this is credit. Okay. Where is it? Oh. Okay, I was talking about this one. Now, let's go through one by one so that I can see how do I make the entry. So first thing, number one, this is revision. Closing inventory value that cost 6,500, but the value of 7,900, market value 7,900. So how do we record this? Okay, in SPL, so I will show, yeah, I will show here closing inventory. So this one. So this is credit the SPL. And then the debit is when I provide into current asset as inventory. Okay, so this is inventory. When we provide inventory 6,005. Done. Now, the second information, salary 1,005, not yet paid. Okay, not yet paid. When I record salary, look at this, I plus 1,005. I plus 1,005, this is debit entry. Okay, where is the credit entry? When I provide in SOFP, credit entry, so it will be under current liability, accrued salary. So I put here credit entry. Okay. Next one. Prepared rent, 800 prepared rent. Prepared rent, when I provide in expenses SPL rental, this one, I minus. So what does it mean? If I minus, this is actually indicating you are crediting it because rent is debit item. Now, where is the debit? So when I provide, okay, prepared rent 800 under current asset, this is actually debiting. Okay. Next one. Interest 100 is not yet received. This is interest received. Not yet received, meaning accrued interest. So accrued interest, so I have to increase SPL, okay, under revenue. This one. So when I plus this one, 100, I am actually crediting. Credit entry. And where is the debit entry? The debit entry is when I provide under current asset interest receivable. Okay, interest receivable, this is actually debiting. Okay. Next one. Commission received in advance, 150. Commission received. So SOFP, okay, under income, I have to minus. So this is minus. So when I minus, this is actually debiting, isn't it? So the credit entry is when I provide in the current liability. Commission received in advance, this one. So this is actually crediting. Now, number 4, a trade receivable, outstanding debt 200 to be written off. Okay, look at the entry. When I provide in SPL as a bad debts, because we don't have the bad debts in the trial balance, isn't it? When I provide this bad debts, that is actually debiting. Okay, bad debts. So this is debit. When I minus under current asset, this minus, this is actually crediting. So complete double entry. Next one. Allowance for doubtful debts is to be increased. So remember the wording increase. Like I've told you before, if it's increased, is an expenses. So meaning you need the double entry. Okay. Normally we debit doubtful debts and then we credit allowance for doubtful debts, isn't it? So remember ADD. If you remember when we prepare this, okay, this is using liability concept, isn't it? So balance CD and then balance BD, closing, and then balance BD like this. So this is fixed already. So if you look at the question, you have opening balance 300, isn't it? So 300. And then closing balance, okay, after you have consider this one to be increased to 500. So meaning your CD, you don't have to calculate, it already been calculated for you. You just record 500. So if it's 500, okay, so total is 500. Use 500 as a total for both sides. In order to make the credit total as 500, so you need to put the bouncing figure here, which is the doubtful debts. Isn't it? We debit doubtful debts, we credit allowance of doubtful debts. So when we provide, yeah, doubtful debts in SPL, this one, 200. 200, this is debiting. And when we use the closing balance, okay, doubtful debts, which is this one, 500. So this is actually credit entry. Okay, which we have, I have shown to you this one, because we need to show this in SOFP, isn't it? So use that amount. Okay. Then we have depreciation. This one also we have learned. When we provide depreciation, okay, we debit depreciation, we credit ADD, isn't it? So this one is based on using the straight line method. So 20%. Look at motor vehicle. How much is motor vehicle, Kelvin? The cost 22,000, isn't it?
22,000.
Yeah, 20% of 22,000. How much?
4,400.
Yes. So 4,400. Okay. You have that in your answer. And then for furniture, useful life of 6 years and nil scrap value. So the same thing using straight line method, but we use the formula. Okay. So the cost of the furniture, 12,000, you divide with 6. So 2,000 each year. And office equipment, 25% per annum on cost. So everything is straight line method. So the only thing is how the question is presented differently. Okay, so meaning this one also 25%, you times with office equipment 15,000. So resulting 3,750. So how do we record this? When we provide depreciation, okay, in the SPL, this is how we provide. When we provide this, 4,400 is debit. 2,000 is debit already. So all these are debit entry. And where is the credit entry? The credit entry is when you put into accumulated depreciation. But since this is the first time, accumulated depreciation, we don't have opening balance, so 4,000. So this is credit. And then 2,000, this is credit. This is all credit. Okay, so we don't have the opening balance. This is the first time we provide depreciation. If we have a opening balance, so you just plus. You plus 4,400, you plus 2,000, you plus 3,750. Okay, so that is how we do the recording. So let's go through again. Okay, first thing, when you prepare the statement profit or loss, okay, you must have the heading, the name of the sole proprietor, and then the heading, statement of profit or loss, and you must state this is for the year which ended on 30th of June 2017. So that heading also, it is indicating to you you are closing the ledger account. Okay, so only for revenue and expenses. So remember, like what I've explained to you, the format, how to remember the format. Okay, we have two objectives in order to prepare the statement profit or loss, to find gross profit and to find net profit, correct? So sales less cost of sales, then you get gross profit. This is how I remember. Gross profit plus other income less expenses, then you get net profit. But remember, if you have the general formula for cost of sales, opening inventory plus purchases less closing inventory. But sometimes you have purchases related expenses on purchases. So you need to break it down where you need to use the first column here. Look at this first column. So you only use this first column if you have related costs on purchases. Like we have purchases, okay, less return outward, plus wages, plus insurance, plus custom duty if you have. Okay, so that is why you have here purchases 43,200, less return outward, okay, plus carriage inward, plus import duty, plus wages, plus insurance on purchases. So this is what we call related costs in order to make the purchases. Like carriage inward is transportation on purchases. Import duty, okay, because the purchases is from overseas. Okay, we need to buy insurance. And wages is the salary for the laborers that is used in order to unload from the container. Okay, so all these are related costs on the purchases. So you have to plus it in order to find what is your actual cost of goods sold so that you make an accurate analysis. Okay, so that's why opening inventory is the available good for the company to sell. And then plus with the newly purchased, so that is why opening inventory is no longer carry forward because they are used and already sell it to the customer. So these are the total good available, 58,300. Yeah. But then after we do the stock taking, so we have identified the closing inventory only worth 6,500. So this is remaining, not been sold yet. So we have to minus we have to minus because we want to see or we want to evaluate, measure the actual cost of good that is being sold to the customer. Okay, so the actual cost is only 51,800. So make sure you put negative value because this is the formula is look at this opening inventory plus purchases less closing inventory. So meaning you need to less sales, less cost of goods sold, cost of sales. So minus 51,800. Okay. So the sub column, column 1, column 2, this is where you need to use it, okay, to do the adjustment so that you don't mix up. After you get the final figure, then you put into the last column. So make sure the symbol, okay, you must minus. So sales minus cost of sales. So you have a gross profit 36,200. Then you list down all the income on the second column. Okay, we have only two. One is commission received and one is interest received. So don't forget, okay, consider all the adjustment that we have done just now. So if it's prepared commission received, so you have to minus. If it's accrued interest received, then you plus. Right? So then only the adjusted figure, okay, you plus and then put into the last column, but make sure this is add, isn't it? So because this is add. Add means credit in SPL. Then after that, you less expenditure. So expenditure, you list down all the expenses or the expenditure in the second column. So after you have totaled it, yeah, then put into the third column. But again, don't forget the symbol. You minus 45,250. So 38,000 minus 38,650, the total revenue. Okay, less with 45,250. So expenses is more, meaning we have a loss. So this is net loss, 6,600. So only the revenue and expenses presented one figure, the difference between revenue and expenses, which is here indicated the net loss. So the net loss belongs to the owner. So that's why it is listed in the equity. Okay, so we do the equity side first. So 74,000, the opening capital from the trial balance, less net loss, 6,600. If it's profit, you plus, isn't it? And then this is net loss, so minus. So we have 67,400, less growing, 2,300 from the trial balance. Then this is the capital, 65,100. Okay, so remember, the owner is providing all the capital. So whatever loss or profit, that belongs to the owner. So you need to put into the equity. So that's why if it's net profit, increasing the equity. But then if it's net loss, reducing, so less. Okay, we don't have long-term liability. Okay, remember long-term liability is those liability repayment period more than 1 year. So if we look at the trial balance, we don't have. So the only thing that we have is current liability. So list down the trade payable. Okay, the accrued salary, this is coming from the adjustment just now. And then commission received in advance also from the adjustment. And the last one is your bank overdraft. So bank overdraft, meaning this is the money of the bank that is being used by the business. Okay, so then after listing on the second column, so your total, then you plus with the equity. So total equity plus liability, so 81,250. So you make this figure as a total for asset as well, because remember, asset equal to equity plus liability. So meaning we have the complete list of equity and liability. So this should be the total of asset. So you move backward. So this is the one for you to find out. If you get the same figure as for the total asset, meaning you have done correctly. If it's not, then something is not right. So you have to investigate. But you list down accordingly first. So for asset, you start with non-current asset, followed by current asset. So non-current asset, okay, for those assets can be used more than 1 year, like motor vehicle, furniture, and office equipment. But you only take into account the net book value. So you have to put, okay, you have to show the accumulated depreciation for motor vehicle, accumulated depreciation for furniture, and office equipment. Okay, you minus, then this is the net book value. You list down on the second column, then you total. So only the final total you put on the third column. Same goes with current asset. You use second column, but except for trade receivable. Okay, trade receivable, you have few adjustment, so you need to use the first column. So which is, okay, we take the trade receivable net after the bad debts just now, 12,005, and then we have allowance for doubtful debts. So you minus 500, so the net trade receivable is 12,000. So why we present lesser than the actual amount? Okay, this is in observance of the prudence concept, right? Which the business do not overstate the amount of asset that is trade receivable. Okay, and then we have adjustment just now, the year-end adjustment, we have prepared rent, so 800. Then interest receivable also from coming from the additional information. And we have existing fixed deposit from the trial balance here, 20,000, and cash 3,000. So you total the current asset, okay, and then you move to the third column, and plus with the non-current asset, you should be having the same amount, 81,250. Now, that is the first illustration. Can you follow? Can you understand?
Okay.
The bracket things do do we need to do the bracket calculation only when there's based on the
Yeah, the bracket
additional information?
you need to do.
Okay. The
That
bracketing
is
for
to show the working, showing the
that's the
working.
work. The bracketing is usually for the additional information we need to do extra things.
Yeah, you show the working. That is part of the working. You need to put in because the mark, some of the marking scheme, they provide mark, some they are not. So in order to be, I mean, in a safer side, so we just provide the workings. Okay. Good question. Now, can we move on to the next one, illustration number 2?
Okay.
Okay. So Harold Trading extracted the following balances. So remember, the first thing is you have to classify all this first. Where does it go to? Okay, so it will be much easier. Now, this question, okay, a little bit hard. You see, they combine sales and purchases. So you don't know which one is sales, which one is purchases. Okay, so remember one thing, sales is revenue, a credit item. So it should be on the credit side. Purchases is expenses, a debit item, should be on the debit side. Debit item, debit side. Credit item, credit side. Okay, so this is purposely, you know, they arrange in such a way just to confuse you. You might thought this sales amount is 53,900, but it's not. So just remember, sales is credit item, revenue. So it should be in the credit side. So same goes with return. One is inward and return outward. So inward, remember, increase of inventory. So it should be on the debit side. Outward is reducing the inventory level. should be on the credit side. Okay. Return outward will together with cost of sales. Return inward together with sales. Okay. Carriage inward, this one is your cost of sales. Salary, okay, this is your expenses. Rent, okay, is on the credit side, so rent received. Commission, on the credit side, commission received. Now, interest, this one you have to be able to identify which one is expenses and which one is revenue. So debit is expenses.
The carriage inwards and return inwards, are they the same thing?
Carriage inward and carriage?
No, the carriage inward and return inward. Is it the
No,
same
they
thing?
are not the same.
Oh.
Carriage inward is transportation cost for purchases. Return inward is good return by the customer.
Oh, okay.
Yeah. So if you ask carriage inward and carriage outward, is both is transportation cost, but outward is for sales. Okay, the difference between inward and outward is treated as other expenses, but carriage inward as cost of sales. Okay, good question. Now, where was I? Interest. Okay, this is interest expenses, 1,100. Interest received will be 2,000. Insurance expenses, utility expenses, premises, this is an asset. Bad debts expenses, fixtures and fitting asset, accumulated depreciation liability. Using liability concept, motor vehicle asset, accumulated depreciation motor vehicle is liability. So you need to attach together and the non-current asset. Now, trade receivable and payable. So how to identify trade receivable is an asset, a debit item should be on the debit side. Payables is liability, a credit item should be on the credit side. Okay, allowance for double debts, this is using liability concept. Bank, cash, and asset. Yeah. Okay, drawing under equity. Okay. Where was I? Capital, equity. So now additional information. So inventory 31st of March was valued at cost 7,500, market value 8,009. So use the lower, which is the cost 7,500. So meaning you include into part of the cost of sales that is actually crediting. And then we debit is when we provide into current asset. Right? And number two, 20% of the salary wages payment for warehouse employee. What does it mean? Meaning, this is wages. Wages is part of cost of sales. So wages, cost of sales. So which is 20%. Now the salary here is 12,500. So 2,500.
The
So
wages and payments, the wages and salary should be different. Different things.
It's the same thing, but one is related with purchases, and the other one is general salary, not related with the purchases.
Oh,
So
so
salary, yeah. So you don't include in the cost of sales for the salary, which is 80% here, according to this information. So the salary is 10,000. Okay. So this one goes to cost of sales. Okay, we go one by one. Now, just now, inventory. I provide inventory. Okay, when I do the recording, when I provide inventory here, 7,500. This is actually crediting, but because of this symbol less, so we presented under debit, but then we change the symbol to less. Okay, this is debit credit entry. And where is the debit entry? Okay, the debit entry when we provide under current asset, okay, 7,500. So this is debit entry here. So that is for the first information. Now, number two, 20% of the salary, okay, meaning in the cost of sales, okay, by providing this, okay, this is we include it to the cost of sales and wages. Right? And the salary, okay, only 10,000 under other expenses. Okay, it's already been paid, but now we only allocate. So 20% goes to cost of sales, 80% goes to the normal expenditure. Okay, that is how we do the adjustment. Now, next one. No record was made for utility bills of 350 that was received. Okay, no record, meaning we have 350 accrued utility bills. So what is our adjustment? Okay, so utility bills, look at this, utility bills. So we have 3,600, that is from the trial balance, already paid. So this is the adjustment, we plus 350. So when we plus, is actually debiting. Okay, this is debit entry. Okay, what about credit entry? When we provide under current liability, accrued utility. So this is credit entry, liability. Okay. Next one. Insurance was paid for the year ended 30th of June 2018. So this one a bit tricky. So make sure you understand. If you look at the ending period of this illustration number 2, ending period is 31st of March 2018, isn't it? So meaning beginning is 1st of April 2017. So this is your accounting period. But insurance period is different. Was paid for year ended 30th of June 2018. So also 1 year, insurance period also 1 year, but the ending is different. 30th of June 2018. So beginning, okay, 1st of July 2017. So meaning we only take into account 1st of July 2017 until 31st of March only, up to this date. So the rest, that is from April, okay, April, May, and June, okay, we exclude. So how many months? So this is 3 months. So look at the insurance amount. How much is the insurance amount? Insurance is 1,200. Okay, 1 year. So you divide by 12 times only, you times the prepared, yeah? Times with 3 months. There are 3 months here. 4, 5, 6, huh? April, May, and June. So 3 months. So meaning equivalent to 300. Okay. So that is why insurance 1,200 we do adjustment minus minus 300. Minus 300. This is actually credit entry. Okay. Where is the debit? When we provide under current asset. Prepared insurance 300. So this is debit entry. So far, are you following? Noel?
Why divide 12?
We divide by 12 because insurance are given a paid 1 year.
Oh,
1 year meaning the 1,200 is for 1 year. So we assume accrue evenly throughout the year. So we divide by 12 lah. So 1 month is 100. So since 4, 5, April, May, and June is in advance, so we have to exclude from that amount. So we only take from 1st of July until 31st of March. Okay, when your insurance period and accounting period is different, so we have to do adjustment.
oh, okay.
Sarah? Can you understand?
Okay.
Okay, divide by 12 and then times 3. So 300 only is considered as prepayment. So prepayment, we have to minus, that is when we minus the insurance, so that is actually crediting. So the debit entry when we provide under current asset as prepared insurance. Okay, and commission 400 has not yet been received. This is commission received. Huh? So commission received. This one another thing. Huh? So commission received in SPL under commission received. So we plus. So plus 400. This is a debit item, isn't it? So plus 400 debit item. So this is actually crediting. Where is the debit? The debit is under asset, a debit item, a current asset. So current asset, we have a commission receivable. So this is debit. Now next one. And 14-month rental was received, which included 2 months deposit. So rental receipt is is a credit item revenue. So 14 months, 1 year, 12 months only, isn't it? So meaning 2 months is in advance, which is that is representing 2 months deposit. Yeah, is in advance. So we have to do the adjustment. Okay, do the adjustment. We minus the rental received with that amount. Okay, this is your rental received. Okay, minus 700. And how do we get 700? Again, this is 4,900 per year. 4,900 per year. So meaning you divide by 12 lah. Divide by 12 and then 408.33 times 2 months. When? What was the question? Oh, sorry. 14 months rental was received. So meaning divide by 14, not 12. Huh? So you have 4,900. Yeah, this is the amount, 4,900 in the trial balance. So divide with 14 months because the additional information stated, and 14 months rental was received, which included 2 months deposit. So you have to divide by 14 months. So divide by 14 is 350 per month. So 350 per month. So in advance is 2 months. Okay, 12 minus 14 minus 12. So 2 months times 2. So 700. So that's why when we minus 700, this is actually debit entry. Where is the credit entry? So the credit entry when we provide in SOFP as current liability. Okay, we have here rent received in advance. So this is credit entry, 700. Okay, no? Number 4.
Okay.
Now it's okay. Then next one, number 5. An additional amount that is due from Mr. T of 200 is to be written off as bad debts. So this is bad debts. So bad debts, remember we have existing one, isn't it? In the trial balance. So you need to plus with the existing bad debts. So in SPL, you have bad debts here. Okay. So we plus 200 from the information, plus 200. So this is actually debiting. So the next entry should be credit. So credit is in SOFP under current asset, we have trade receivable, isn't it? So which is we minus 200. So this minus 200 is actually crediting credit entry. So done. Okay. Now the next one is allowance for doubtful debts is to be provided at 440 on 31st of March. So meaning 440 already been calculated for you. You don't have to calculate. So look at what is your opening balance. So I just want to, illustrate in a ledger form, so it will be much more easier for you to understand. This is allowance of doubtful debts. So BD opening and closing. So balance CD, then balance BD. So this is how you record it. So opening balance, if you look at the trial balance, how much? 250. Okay. And then
Oh, yeah.
From the additional information number 5, so we have 440. So that is closing balance. So meaning 440 is the highest total. Use that as your closing, your total. So meaning to say this is an increase. Okay, before 250, but now we have 440, an increase. So meaning definitely your doubtful debts is expenses. Okay, so the difference is 190. So 190, the balancing figure will be on the credit side. So doubtful debts will be debited and ADD will be credited. So look at this in the SOFP. Okay, we're gonna use this balance, okay, to minus with your trade receivable. Okay, so first thing we debit by providing into the expenditure. as doubtful debts. Look at this, doubtful debts. So this is debit, 190. And where is the credit? The credit is when in the current asset, you will have allowance for doubtful debts. We use the closing balance, 440. Okay? Then the last one, motor vehicle, 20% using reducing balance method. Now this is reducing. So meaning, if it's reducing, so you need to minus first. Motor vehicle, okay, 40,000 minus 4, you need to get net book value, okay? So 40,000 minus 14,400. Okay, 40, okay, to get net book value, 40,000 minus 14,400. Then you get 25,600. Then you apply times how many percent? 20%. So 5,120. That is the amount. 5,120. Yeah? So we debit depreciation, we credit accumulated depreciation. So as you can see, when we provide expenses, okay, depreciation, this is debiting. Debiting. Where is the credit? The credit is when we record under this one, we plus, yeah, we plus 4,000, we plus 5,120. So this is credit because we have the opening balance, isn't it? From the trial balance. So opening balance for the accumulated depreciation. So by adding, because this is a credit item, so this is actually crediting. Adding is crediting. Plus 4,000 plus 5,120. So done. Okay, so let's go through. So remember, okay, we have 3 columns. So the first column will only be used if you have other expenses related with the purchases. Okay, so that is why we have here purchases, you less return outward, plus with carriage inward, and plus with the wages, because wages you have the allocation, okay, which is 20%. Then we get the amount of purchases, so we put into the second column. So opening inventory plus purchases less closing inventory. Then the adjusted amount, the net amount, then we put on the third column. But remember, the symbol, you must put the bracket here so that you need to minus with the net sales. 25,500 less cost of sales. So you have 37,800. So that is fulfilling. Okay, like what I've said to you, in order for me to okay, to remember. Oh, yo, what is this? Remember the formula. Sensitive. I move also. Oh, yo. Oh, functionally. Okay. how to get gross profit? Gross profit. So sales less cost of sales. So this is sales. Cost of sales is this one. Yeah. So remember, cost of sales, you have to break it down. Okay, that is opening inventory plus purchases less closing inventory. So this is referring to the second column. And purchases, okay, we can further break it down. Remember, purchases less return outward plus carriage inward plus wages. Okay. Now, then we get gross profit. So gross profit plus with all the other income, okay, you list down on the second column. So after all the adjustment, you have considered adjustment. Then the total amount, then you move on to the third column, you plus with the gross profit. Okay, plus. Huh? So we have a total 46,950. Then you start listing other expenses. Other expenses on the second column. Huh? So with the adjustment. So salary plus interest plus insurance, utility, bad debts, doubtful debts, depreciation, fixtures and fitting, and depreciation of motor vehicles. So we have a total expenses of 25,960. So you minus 46,000 minus 46,950 minus 25,960. So you have a net profit of 20,990. Okay. Then we do statement of financial position. So list down all your non-current asset and current asset first. Okay. So you only take the non-current asset, the net book value. So fixtures and fitting, you minus with the accumulated depreciation. So the net book value you put on the second column. Same goes with motor vehicle, put on the second column. So you plus 85,000 plus 12,000 plus 20,480. Then move on to the third column. Okay. Then current asset, we have inventory. So the trade receivable, you have to show the adjustment in the first column first. 11,000 you minus with 440. Then the net trade receivable you put on the second column. Okay, and then list down all according to the adjustment just now, prepared insurance, commission receivable, we have bank and cash. So the total current asset, then move on to the third column, plus with the non-current asset. So you should have 145,240, same as the equity plus liability. So again, we don't have non-current liability here. So we only have current liability. So show the opening capital plus the net profit that we have calculated in the SPL. Okay, 20,990. Then minus the drawing. So this is your closing capital, 127,690. Then we have current liability. Okay, list down all the current liability on the second column. Then move on to the third column plus with the equity. Then you should have the same total, 145,240. Now, can you understand?
Sir, the bad debts need to record in the SOFP.
Bad debts, we don't record in the SOFP, but then you see, you show the working under trade receivable here where we minus. This is credit entry just now, isn't it? The trade receivable 11,200, we minus 200. If you're talking about the existing in the trial balance, we have how much the existing? 500. Yeah, we don't show it in the SOFP because that one, remember what you have in the trial balance, okay, this one, bad debts, This one already completed double entry. What I say, what does it mean completed double entry? We already done, we debit bad debts. So this is debit bad debts. And we credit trade receivable. So trade receivable here is already minus this 500 and become 11,200. So we don't have to show anymore. But what we have in the additional information, now this is not recorded. So that's why we do the recording. So that is, we add with the existing bad debts just now, that is debit. And then the credit is when we show in SOFP under current asset, okay, that is minus. Okay, we minus 200. Is that what you're asking? No.
Okay.
I answer your question. Okay.
Okay.
What about Kelvin and Farah? Do you understand?
So this today also always just they count as yearly report this for this financial statement. And
Or you mean the preparation of the financial statement? Yes, this is done on yearly basis. 1 year.
is it possible? Is there like a statement profit or loss for a month, for the month only, and not for a
Depends
year?
on the company. Can.
Oh, okay.
The company also can. So you have to read carefully. So sometimes they use monthly, or they use 6 month, half yearly. Okay, for control purposes. Okay. Now, can we just continue? Next one is illustration number 3. Okay. So New World extracted the following balances from the ledger 31st of July. So remember, this is 31st of July. Yeah? So 31st of July. So accounting period, identify the accounting period first. 31st of July 2017. So beginning will be 1st of August 2016. So you need to look into a transaction that falls within this period gap. Yeah. Okay. So we have identified first all this. Remember, this is office equipment, asset, accumulated depreciation using liability concept, delivery asset, accumulated depreciation using liability, machinery as an asset, drawing, equity, capital, equity, loan, liability. This is long-term liability. Inventory, this is part of the cost of sales, purchases and sales, purchases on the debit side, sales on the credit side. Return inward, okay, 2,700. Return outward will be 2,900. Outward reducing, so reducing inventory should be on the credit side. Inward, increasing the inventory should be on the debit side. So carriage, yeah, 3,008. So can be inward and outward depending on the additional information. Salary, expenses, discount, we have 2. One is received and one is allowed. So allowed is debit expenses, isn't it? Received is revenue, so on the credit side. Rental, okay, this is rent received because on the credit side. Insurance expenses, utility expenses, bad debts expenses, trade receivable, debit, trade payable, credit, okay, allowance for doubtful debts. You understand? Trade receivable is an asset, so it's debit. Payable is liability. Liability, excuse me. Bank, cash is an asset. Okay, look at the additional information. So remember, closing inventory. Okay, wait.
Or the receivable is credit.
Huh?
It's the receivable credit and then the payable debit.
No, trade
Oh.
receivable is an asset.
Yeah.
Debit.
Okay.
Okay, debit. And then payable, liability. Just look at the word. Internalize the word payable, meaning you have to pay. So liability. Receivable, you are receiving. The business are receiving is an asset, so debit. Okay.
Okay.
Now closing inventory. Okay, normal. Take the lower, that is cost, right? And then 1/3 of the salary. 1/3. 1/3 means 1/3 for warehouse employees, meaning this is wages. Okay, a quarter. Okay, look at the answer. 1/3. So meaning, you see, the wages here, 21,000 from the trial balance. You divide by 3. So divide by 3 times 1. So you get 7,000. 7,000 for wages. Okay. So 7,000 for wages. And then salary. Okay, the other two portion. 2 times 7 is 14,000. So look at salary here, 14,000. So just the allocation. Now, and a quarter carriage expenses is to deliver good to warehouse. Good to warehouse, meaning related to the purchases. Yeah. So it's a carriage inward. A quarter. A quarter we divide by 4. So here, wages, sorry, carriage inward. So in the trial balance, we have 3,008 carriage. So we divide by 4, so meaning 950. So 950 is a quarter, 1/4. So we divide by 4 times 1 is 950. So the balance, that is 3/4, is carriage outward. Look at this, carriage outward. And then 3,800 divided by 4 times 3.
One is just 1/4 and the other is 3/4.
Because the wording is a quarter. A quarter is for the warehouse. The question says a quarter is for the warehouse, isn't it? Did you see the wording?
Yeah. So it's just 1/1. So it's just 1/4 and then the other is 3/4. Yeah.
So the remaining will be 3/4 lah. Because a quarter means we divide by 4. Okay. So carriage expenses is to deliver good to warehouse. So underline warehouse. Warehouse meaning referring to the cost of sales related with the purchases. Okay. So related with purchases. So meaning to say, so only you divide by 4, only one portion belongs to the purchases. So which is 950. So the remaining balance, that is, if divide by 4, so remaining is 3 out of 4, isn't it? So times 3, so 2,850 for carriage outward. Okay, then utility bills 350 for July 2017 was paid twice. Okay, utility bills for July was paid twice, meaning we have in advance, isn't it? How much? In advance twice, so 350 lah. Yeah. So meaning to say, when we do the adjustment, your utilities, this is your utilities. So you need to minus 350. Okay, minus 350 is actually, we are crediting the debit item. So if this is credit, so the next entry should be debit. So the debit meaning none other than it goes to SOFP under current asset. Prepared utility. So this is debit. Are you following? Can you understand?
Yeah.
Okay.
And, yeah. And insurance premium. Notice was received, but not yet paid for the year at the 31st of July 2017, amounting to 500. Meaning you have the insurance, yeah, in the trial balance. The amount is 6,400, but you have this another notice, but not yet paid. So meaning is inclusive for the year. So you have to increase. So plus 500, and this is not being paid, so become liability. Okay. So meaning to say, your insurance here, you need to plus 500. Okay, this is debiting. And the next entry should be credit. So under current liability, not being paid, insurance. So insurance, accrued insurance, 500. So this is credit entry. Rent, 400 not yet received. So not yet received, indicating this is revenue. So meaning rent received. So you have existing 4,400. So you need to plus, yeah? You need to plus. So plus credit item means we are crediting under income. So rent received here, we plus 400. So we are crediting. And where is the debit? The debit will be under current asset. Current asset, rent receivable 400. Okay. Additional amount due from Miss K, 600 is to be written off as bad debts. So we have existing bad debts in the question. Do we have? We have 1,003, isn't it? So that one already double entry already completed. So this one is a new one. We have to do the entry by debiting the bad debts and then crediting Miss K, crediting the trade receivable. Okay, so how do we record that? Okay, we debit. Okay, with plus bad debts. Yeah, we plus. And then in the trade receivable, we minus 600. So this is credit. Allowance for doubtful debts of 1,400 is to be provided as at 31st of July. So meaning indicating the closing is 1,004. So your opening, okay, in the trial balance is 2,000, this one. So meaning this is an old provision and the new provision is lower. So this is decreases. So decreases, meaning it will be, under other income, not expenses. So decreases in AFDD, so this one, okay. So this is credit. Okay, credit. And where is the debit? So the debit is actually in the doubtful debts. That is, we use 1,004 here. Okay, that is, you see, if I do ADD, balance brought down, opening, okay, closing balance, balance CD, balance BD. So this one is 2,000. And according to the question, we want to make it as 1,004. Yeah, 1,004. So 2,000, isn't it? 2,000. So ADD here is 600. So the balancing figures, meaning ADD is debit, doubtful debts is credit. So that's why doubtful debts become revenue. Yeah, other revenue. And when we use the closing balance here, it's actually indicating we already done the credit entry. Okay, 35,000 minus 1,400. Okay, and we have depreciation. Okay, if you look at the question, depreciation, office equipment 35% using straight line method. So we just time with the cost. Okay, from the trial balance, 30,000 times 25%. So 7,005. This is debit. And credit is when we provide, okay, and office equipment. So this one. When we plus, that is credit. Motor vehicle, also the same thing. That is motor vehicle is 20% using reducing balance. Using reducing balance, meaning the cost of your motor vehicle, 60,000, you minus with 29,250. Okay, the net book, you get the net book value. So this is net book value, 30,720. After cost, 60,000 minus 29,280. Then times 20%. So this is the depreciation amount. So this is debit. And credit is when we add the cumulative depreciation. And machinery, 15% on cost. So 15% of 48,000, 7,200. So this is debit and then credit. Okay, when we put, this is the first time, so we put 7,200. Okay, so this is the net book value. So done. Any question? So we don't have time anymore. Do you have any question in particular? I wanted to go through the illustration number 4 on your own. Then let me know if you have problem.
Oh, okay.
This chapter is like chapter 4, but just got extra additional information. Need to know what to do.
Noel,
Oh.
It's
your
more or less the
correction, I
same, but
already
then
pass it back to you.
you have to
I think you still make
consider
a
all the
mistake
adjustment.
about
Why
the
we
track
have
payable.
adjustment? This is in
There's
observance
a
of the
discount
accounting concept
received.
that we want to prepare the financial statement according to true and fair view.
I think
Okay.
50 and
So
what? 50 and 600.
using
So you
matching
put 50 and
concept,
600. It's actually 50 and
using prudence
550.
concept,
Yeah.
right?
Huh? Why attending 2 classes?
Now,
Oh, okay. Never mind,
any
you
other
finish your
question you
lecture
want to
first.
ask?
No for me.
For me, Farah. Okay. What about you, Calvin?
No.
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 No. Okay. So I'll see you on Thursday and prepare, study hard for your test, Calvin and Farah.
Okay.
Okay.
Score as high as you can. Right. Okay. Bye.
Okay, sir.
Okay.
Thank you.
Thanks.
Welcome.